Hello, good evening, everybody. Welcome to Market Analysis Live for Sunday, July the 6th. It is now 8 p.m. This is George from TRADEPRO Academy. How is everyone doing? I hope you're all feeling fine and you're having a grand old time. It's a beautiful Sunday. The weather here is absolutely fantastic. And yeah, so the opportunity cost in the summer is high for these webinars, but so too is the profitability and the return potential as well. All right, so we've had a really exciting week in the markets. A lot of things have taken place, but it also has been a holiday weekend in the last couple sessions. So on Thursday, the market closed at 1 p.m. Eastern Time. All right, Friday, the entire United States was off celebrating Independence Day. All right, so happy Born Day to all the American friends down south. All right, we hope you had a grand old time. I know there was some fireworks, I know there was a good celebration. People fire up the barbecue and have a great old time. So hopefully you've enjoyed that. As of Monday, the markets are back to the regular hours. So essentially what's going to end up taking place is we're back to work, guys. The holiday's over. I hope you've enjoyed it, but now we're back to work. Time to punch the clock and get started with some of the trade setups and market overview. All right, can everyone see the screen? Can you just give me a yes if you can see the screen? And we'll rifle through and get started here. All right, perfect. Okay, so if you guys can see the screen, let's get started. First and foremost, you know how we start every single webinar. The information contained in the presentation is for educational purposes only and is not to be taken as investment advice. All right, the risk of trading in securities markets can be substantial. You are entirely responsible for anything you do to your trading account. What we're discussing tonight is only educational content. It should not be construed as investment advice. At the end of the day, you're the operator of your account. All right, you're also the benefactor of any profits and the sole person responsible for any losses or liabilities that result as part of your market involvement. All right, guys, so there you have it. There's a little piece that we had to share with you. We absolutely must share with you. Just give me one split moment if you don't mind. Okay, there we go. Everyone's in. Can everyone see the screen? Please let me know. Just give me a quick yes or no. It will help me. I don't want to go through here and go crazy and assume that you guys are seeing stuff, but you can't. Okay, perfect. All right, let's get started tonight. We have some interesting stuff to share with you. A lot of people are now pouring in, so once again, happy July the 4th and happy Independence Day to all of our friends in the United States. All right, so let's get started with a really interesting slide I wanted to get to today. It's called Up, Up, and Away. All right, the Dow Jones has officially closed above 17,000 for the first time ever. All right, it's a party. You know how they have those hats with Dow 10K? Well, now we could have a Dow 17,000K or 17K hat that people can wear. Right? It closed 17,068. That's a pretty high jump from the 17,000 psychological resistance point. All right. Here's how it looks. So we're above the previous high. Things are looking good. All right. Well, what are some of the leaders and laggards? While the overall 6.6% jump is from Caterpillar for this year, the top 5 performers, Walt Disney, Intel, Merck, and Cisco, relatively large companies. In the bottom 5, well, Walmart hasn't done so well, so retail sales, people are wondering, is it the store, is it the industry overall? Pfizer, Procter & Gamble, Verizon, Boeing are what's holding the market down currently. All right, so it's an interesting chart. You look at this and you say, holy geez, the economy must be doing fantastic. All right, that's what a lot of people would say. That's what they would assume. If you look back 100 years' time from now at this chart, people would say, wow, there's a lot of people getting rich. The economy must have been doing spectacular, no matter where they are in 100 years' time. All right, well, here's the interesting part about all that. Volume doesn't want to play. All right, so the Dow Jones is up, up, and away, but the volume doesn't seem to want to play with us. And the orange here is the volume. The blue is the closing value of the Dow Jones. As you can see, yes, it's a higher high. It's looking great, but it's happened on lower volume. All right, so these are diverging, these two. And if you guys have been for any classes at all for the TradePro Foundations course, level 2 lesson 1 is the absolute most important. The volume principles and introduction. So what does this mean to you guys? Remember, volume leads the price. All right, and if the volume leads the price, well, where's the volume going down while the price is going up? So this is an area of concern for us. There's 2 reasons this could be happening. One is high frequency trading, HFTs taking volume off the public marketplace and into dark pools. More on that tonight, actually. We're going to do a little piece at the end. Instead of a motivational piece, a little introduction to high frequency trading. And the second part could be because of the holiday. We had a shorter week, all right? That explains the last few days, but not the entire trend going on for the most part. So there you go. It's a multi-year trend from really 2010 onwards. For the last 4 years or so, that's been going up on lower volumes. So this is an interesting thing for us to have a look at. Well, a lot of people might ask, what for is causing the market then? What is causing that market to go higher and hit these higher highs? Well, here's an interesting chart that I pulled. This one is from Capital IQ. All right, and this is the S&P 500 buybacks quarterly. All right, what is a buyback? Well, here's a brief introduction to a buyback. A company sells product. All right, because they sell product, they earn revenue. Because they earn revenue, when they clear their expenses, hopefully what they're left with hopefully equals a profit. All right, well, what can you do with a profit as a company? The one thing you could do is go out there and invest it and earn a return. The second thing you could do out there is to produce more of your product. If you're a company that makes, let's say, I don't know, plastic cups, well, maybe you could try different color cups, different cups for different things. You could invest it in your business. Or the third thing, and it's not the only other thing, but one of the other things taking place now, and the third thing in tonight's webinar we're going to talk about is buybacks. That means the company takes their profit or a portion of their cash, goes out on the market, and buys their own shares. What does it mean when a company buys their own shares? Well, they're saying that 1 and 2 aren't that attractive. They're saying they can't earn an investment return anywhere else to outperform buying their own shares. The number 2 thing they're saying is, what are they telling us? They're saying that their product, could use improvement. They can't invest it in themselves or in the market to earn a better return. So they're saying, hey, we're going to buy our own shares. And it's an interesting thing to do. Why is it an interesting thing to do? Well, most importantly, the number one thing it does is it improves the financial ratios for a lot of companies when you buy back your own shares. All right, Warren Buffett's a huge proponent of this. He says companies who have a lot of cash, that are hoarding cash, which is a company mostly like Apple, they have a ton of cash on hand, should use it to buy their own shares only when the shares are believed to be undervalued. All right, now that's the Buffett philosophy. As traders, what do we think about undervalued? There's no such thing. Everything at any given point is fairly valued. That's what we assume in order to be professional and profitable traders. Look at the buybacks since June of 2009. They've skyrocketed. They're at an all-time high. So if you ask why is the market going up, what is creating this demand in the marketplace? Well, it's buybacks. That's what's creating it. That's one of the big factors in the world, or really in the markets, that causing it to propel higher so much. So look, 120. This is in billions, I believe. So it's $120 billion of buybacks. And then the crash happened. Where are we now? We're at 160. We've beat this 120 up in September of 2013. All right, so buybacks are a record high, and the question becomes, is the stock undervalued? All right, or do they want to improve their financial statements? Why do they improve financial statements? I'm going to get into this very quickly. All right, one of the things that they do is any ratio on top, whether it's profit margin, whether it's sales, all right, which is the same thing as revenue, which is cost, whatever it is. All right, if you divide it by a lower denominator, which is usually where number of shares go, all right, what's better here, a lower number or a higher number if you're looking for a higher overall ratio? Well, you want a lower denominator, don't you? The lower denominator means going out there, buying your shares, all right? It makes things look more attractive. Think about how most executives get compensated. Well, it's based on the fact of these ratios, all right? Profitability, earnings per share, etc. All right, we're not going to go ranting on this that much further. I'm just going to say that this creates real and significant demand, and it's at a level last seen in 2008 before the crash. So buybacks are up there. We're not saying a crash is going to happen, but we're saying this is where support is coming from. Well, here's an interesting situation. What else might be propelling the market or pushing it a bit higher? The Federal Open Market Committee. This is the Fed in the United States, all right? Yellen to buy. Janet Yellen, she's telling you to buy. Well, here's an interesting chart. The S&P 500 index with and without the 24-hour period before the FOMC announces their earnings. So basically, it's a strategy saying if you were to go and buy 24 hours pre the FOMC statement that they release and then sell it right after, this what would happen. All right, and the S&P 500 index, here's a blue. All right, till 2010. I know this is old data, and this is it without the FOMC date, so it's dropped. All right, well, in today's market, it's the same thing. I know that this is only going up to 2011, but this is a past history where we've seen some of this, and look at this. That gap has only opened up. So yes, we're at all-time highs, But a lot of the companies nowadays are still uncertain. They don't know what to do. They don't know where to invest. They don't know how the economy is going to be in the next couple of years. So that goes back to this. Because they don't know what to do, they're going out there and buying their own shares, for a lack of better things. So you can't continue to hoard cash as a business for a long period of time. Investors say, why aren't you using that cash? What is that cash? It hasn't done anything for me. It's no good to me as an investor. All right. Well, here's an interesting situation. What's the income? I called the slide just because I like clever little slide titles, as you can probably tell. Look at this. This is pretty fascinating. In 2006, a $100,000 investment, rather, all right, in a 6-month cash deposit. So this is a very conservative investment. All right. This is basically an income purpose investment. This is when you're in your retirement years, you have a fixed amount of money and you want it to generate income. That's all you care about. All right, you care about income because that's what you're living off of. This is your nest egg. You want it to earn regular income for you. Well, in 2006, 100,000 would earn you $5,240. All right, 6 months. So this is every half year. In 2013, it only gives you $390. All right, so that's really the interesting thing of what's been happening. So people who have been retired or who rely on income from their investments, well, they haven't been doing so well. This is why industries like online trading are booming. All right, so that's us. We're doing fantastic because of this. All right, and other people are looking for alternative investments to yield them some extra income. So there's all these bond funds, all this other stuff that's come out. But the bottom line is income's declining in the same period that the market's boosted up. So less spending power. Which brings us to an interesting little chart that I wanted to show you guys today. Your breakfast. All right, your breakfast might not have looked like this morning or tomorrow or the day before, but here's some essential things that you would see in a breakfast. All right, and we're going to tie it to inflation. So they say, you know what, inflation's ticking up, and boy, were they right. Remember just a couple months ago, people were saying there's no inflation, we got to print more. Mostly the Fed. All right, well, that was back in the Ben Bernanke days. You're saying there's no inflation, there's a deflationary period going on just a couple months ago before it transitioned over to Janet Yellen. Well, look at this. Cocoa is up 8% for the year. Coffee, 72%. Geez, where would I be without coffee? Well, I'd probably be a little bit richer according to this chart. Butter up 18%, wheat up 12%, milk 21%, orange 12%, sugar 6%, pork belly, which is really what's determined or used to determine your pork or your bacon rather cost. Well, in total that's a 24% increase of food prices, and there's actually a breakfast index that people track. There it is. All right, so it's gone up, it's shot up, it's increased with lower income, with lower jobs in today's marketplace. What's happened is the breakfast costs and food prices are increasing, all right, and they're expected to continue to do so. So there you go. There's an interesting statistic for you. Yes, oil, WTI, and Brent, these are the oil indicators. They remain relatively consistent, slightly down, all right, but the food cost has gone up a quarter since last year. Okay, so you're paying 25 cents more for that breakfast per dollar. All right, so we know that the cost of food prices are a strain on some of the consumers. Well, look at this. So Wall Street Journal reports it the same way. They're saying, here's 2013, the yellow dot, the green is forecast for 2014. All right, you could see in every single category except fresh vegetables, all right, prices have skyrocketed. Interestingly enough, fresh vegetables, people probably dropped the demand for that. Food at home has skyrocketed, all right, the food prices, and right now, where we are at the moment, food, oil, which is a cost of transportation, cost of really mobility for yourself, cost of getting to work. Those are the two things that have been going up in the last couple months considerably. It's putting a lot of pressure on consumers. Okay, so what would that mean? Well, that might mean that while the market's at an all-time high, I question where we are personally as a consumer. And really, that deviates from the rest of tonight's webinar because as traders, it doesn't really matter. Whether the market goes up or down, we're going to ride it. We're going to make some money so we can afford our breakfast cereals and breakfast commodities in the morning. Okay, at the end of the day, that's a good opportunity for us. The markets are up. Really, the wealth of the everyday person is down, but that's an opportunity for the two to converge rather than diverge. All right, the markets can put money in your pocket regardless of where they go. All right, let's talk about some sentiment indicators. There's a quick little recap. The MMFI, number of stocks above the 50-day moving average. How are we doing on bar chart? Well, bar chart's telling us it's at a high that hasn't been seen until October or since October of last year. So we are pretty much at a one-year high. Okay, we're pretty close to it. And this means that every time it's skyrocketed up in severe fashion, it has also fell in the exact same fashion as it has skyrocketed up. All right, so there's certainly some downside pressure based on this little sentiment index, and it also tells us the markets could potentially be currently sitting at an overbought level. There's only one thing that comes into this for me saying, you know what, we're going to probably be writing puts the next couple of weeks. There's only one factor, and that's the big E factor, that's earnings. All right, they're going to start coming out, and in a period of earnings, we do not trade. It's a total gamble. We just sit and we wait it out. Okay, so earnings might kind of mess up or muddle up our prognosis on this and really take away any trading opportunities the next couple of weeks. We still have a few left, but they're slowly wearing out as earnings kick off July 14th. All right, let's look at some things from the weekly economic releases. Last week we had spectacular ADP non-farm employment change numbers, 281,000. This gave the market some euphoria, a little bit of lift, and it was largely responsible for closing at all-time highs. All right, non-farm employment change on Thursday before the 1 p.m. holiday. Well, everyone goes on a holiday super happy, and they couldn't have gone any happier seeing a green number. All right, so people went away on greens, lower unemployment rate down to 6.1%. But I question, is it unemployment or people just giving up or being frustrated? And you know what? It made for a great long weekend. It made for a really optimistic couple days off, but we're going to see what happens Monday, Tuesday, and Wednesday of this week coming up. So it's going to be an interesting thing. Now, let me show you this. Those job numbers that came out, yeah, it's a great number overall, the headline figure when you funnel it up into one little wrap. But part-time jobs were up 800,000. Full-time jobs are down 523,000. Let me ask you this. Is this something that's reminiscent of a good market, or is it indicative of a good market or a bad market? What do you guys think in terms of jobs, just labor? Don't worry about markets in terms of S&P 500 and stocks. In terms of labor, do you want to be adding 800 part-time jobs and removing 500,000 full-time? The answer to that, as you guys will probably know, is no. You definitely don't want to be doing that. All right, guys? So you got to dig deeper into these headline numbers, whether they're good or bad. You've got to question these and say, what do they mean? Don't just look at the headline number, go out there and go nuts. That's what they want you to do, but that's not what you should be doing. All right, so more people have part-time jobs, which means they probably can't find full-time jobs, or the ones that are losing their full-time job are settling for part-time somewhere else. So in fact, that's not very reflective of labor market strength. So that's what was an interesting chart I want to show you. Even more interesting, annual and monthly change in real hourly wages are down. For mid-2014, they peaked. They were in this nice little uptrend. Now we've broken through. Look at this. You say technical analysis doesn't work. It broke out, role reversal, downwards it goes. All right, so that's an interesting development. Hourly wages are down, and that makes sense because we're losing full-time jobs, all right, and getting part-time jobs. Part-time jobs tend to be less less paid opportunities. They don't have any benefits, all right, and really it's a lower commitment from a company to the employer, or to the employee rather. They could cut them quickly. They don't pay them any benefits. There's not really an optimism indicator. So there you have it. What's coming up this week? Some interesting stuff. Building permits are coming out tomorrow at 8:30 in the morning. CPI, FOMC meeting minutes are going to come out Wednesday, July 9th at 2 p.m. They're just going to be the meeting minutes here. There's going to be no conference, no questions being asked. So it probably shouldn't cause too much turmoil in the markets. All right, Thursday at 8:30, unemployment claims as we have every other week. And Friday, we're going to end off with the employment change report in Canada and the employment rate, which is the equivalent of the one in the United States that we had last week. Okay, so unemployment rate's still higher in Canada. We're going to see what happens. And good times ahead. So the week is going to start off relatively quiet, and we're going to see where the balance of powers is. Is it going to be supply pushing the markets down, or is demand still going to be there to rocket the markets and propel them higher? And we're going to see where volume lies too, because that's where really the secret is to all of this market development here. Forget about what the price is telling us. Combine it with the volume and find out the real picture. All right? Any questions so far? Because it's time to do some technical analysis. Let's jump into it. S&P 500, here's what this is looking like. This is a nice little pop above resistance. Only one problem with this. It's one single problem, and I'm sure you guys can see it. It's on this chart. It's on the same chart, coincidentally. Well, yeah, the problem is that we had a put trigger, and that didn't quite work out, did it? But also, that might be a problem, but also the good thing is it didn't work out, so we never got triggered on it, so we didn't lose money. All right, not making money is not the best thing. Not losing money is a much fantastic or much better experience. All right, I'd always rather not lose than make. All right, The long run, it'll serve you better. All right, what's the problem? Volume. Exactly. You guys are spot on. Volume's been declining the last couple sessions, and yes, we got an all-time high on low volume. All right, had a resistance level. This is where you have to trust the technical analysis. Okay, you got to have trust in what you've learned, trust in what you do. That will serve you well, and just give it a day or two to settle. We'll see if we get some nice bearish patterns here by the candles with some increasing volume. We're gonna know we're gonna go bearish. All right, for this week though, we're actually gonna stay away from the S&P 500. So we're gonna delete these triggers, and because last week was a short week, we're gonna let supply and demand battle it out, and we'll talk about a trade on the S&P 500 overall, the SPY ETF mainly, next week at some point. All right, other than that, moving averages are looking positive. It's no surprise there, both short and long term. Momentum is diverging strongly. All right, look at this. Stochastics, lower highs, RSI, lower highs, MACD, lower highs. All right, this is what you call a bearish divergence. All right, so you add this into the mix of all the other things like resistance, like an all-time high on low volume, all right, like a bearish divergence, and you're starting to paint a picture of smoke and mirrors. All right, what you're seeing might not be the real picture. You might be seeing an exhaustion here taking place. And if we get an exhaustion gap, even stronger of an indicator for us. All right, so Bollinger Bands, obviously they're opening up, they're expanding because we're getting some bullish movement. Here's where we are. I want to show you guys something fascinating. If you actually take the previous time it's hit a resistance and the main retracement back to support line, when did this happen? This happened in May of 2011. All right, did a triple top, it broke, and it hit the support line. All right, this type of pattern is normal. All right, under the Dow theory, under the core tenets of Dow, this is a secondary move that we're talking about down to support. Remember the waves? One goes up, one goes down, one goes up, one goes down. Well, this is a normal corrective wave. Now, if we took this normal corrective wave and used some high-end technology in today's world and duplicated it, where would it take us from today's market? Well, let's have a look. All right, wouldn't that look pretty interesting? Well, the answer to that is yes, it would. And even if we connect it, let's say it starts at the high. Whoops. Let's try that again. Come on. Come on. All right, well, now I just totally messed it up. Let's go find it. That's what happens when you're scrolling it from the right. Oh, it just disappeared. Here, I'll do it again. If it runs away the first time, we'll get it the second. Don't you worry. Okay, here we go. If we drop it even above that resistance, let's say, it still works out perfect. Isn't that scary good? Wouldn't that be an interesting retracement back to support? Where would that take us into from a timeline or from that time perspective? Well, if we freeze it here, it would take us to December of 2014, so until the end of the year. So could we be entering into the last quarter here, or really the second last and last quarter, could we be entering into a retracement mode back to support or even a correction? And the answer to that is probably maybe. Could we continue upwards? We absolutely could. But if we're going to do that, we got to see the volume come back. All right, volume has to return in the next couple of days. Got to return quickly to the next week or two to get us out of this resistance band and much higher to go up. That could certainly happen, but right now the pressure is on the downside. All right, and that E word times really nicely with this trend. So if earnings are good, who knows? We might get a lift. We might go bullish. If the earnings are bad, this will probably be the catalyst to spark the sell-off. So we're at a very important pivot level, as they call it in the markets. Keep an eye out for that on the S&P 500. Right? Any questions so far? Or comments? Yes, if we extend this trend line, that's a great question. Well, we still have some time, I guess, to muddle around in this area. Here, let's extend it a little bit, but we're running out of that as well. Right? Even if we sit in this rising wedge-like pattern, well, that only gets us to about September. Okay, so we're not saying an immediate drop. We're saying potentially go sideways in a rectangle fashion, and if it breaks on high volume, then we're going to go bearish, and we're going to ride those puts into profitability. All right, Dow Jones, how's it looking for us? How's Dow looking? Well, the Dow is looking very bullish. It broke above this thing that we were trying to call a double top. But remember, the lesson in the foundations course was never call something a pattern until you've seen it confirm. Because down through here, you looked like a superhero, but it didn't break through below the neckline, didn't break bearish, and it actually indeed went up. So always be cautious about calling a pattern too early. It didn't end up being a double top, but it could have been a sweet one. All right, and we always said this one thing of the Dow Jones. It's in the middle of this channel, and it's got a lot more upside on the weekly. Why did the pen go white? I don't know, but we're going to turn it red again. All right, we got a lot more upside on the weekly before we hit the same resistance that we're seeing on the S&P 500, guys. Looking at Compaq, or not Compaq, the company, but CompQ, which is the NASDAQ index, which is largely and predominantly based on tech stocks. We've broken out of the resistance before. We're right above that resistance as well. This channel running back to 2009. But now we're in a new channel, and there's certainly some more upside here. All right, it's interesting. The difference between NASDAQ is late last week there was volume to support this breakout. Okay, so you're seeing a little bit of a mixed picture in the different types of markets. Russell 2000 index on the weekly looks like it's getting into double top area. It's the one index that hasn't broken above the all-time highs. All right, so it's not above all-time highs. It's in fact right at a resistance level, and it's a key resistance level. Whether we're going to get the M for murder double top pattern, or if we're going to continue up, only time will tell. Volume here too is very weak on the Russell. All right, if you want to see a quick little overview of the weekly markets worldwide, these are actually indexes like oil, silver, etc., which is not what I wanted to show you, but interesting look nonetheless. Here's the world equity markets basically. Shanghai is, or sorry, the Sanghang is the blue, Nikkei 225 in Japan, FTSE, DAX is in Germany, the CAC is in France, I think FTSE is London. So these are in the international equity markets. You'll notice a lot of them are kind of at the point where they're at their previous highs. If you look at Nikkei 225, which is Japan, remember the 90s lost decade we talked about once? Well, look, they're still down here, so they haven't even made any kind of recovery. They've been killed since, and that's where it remains. While the S&P 500 is the only one trading above its all-time highs, a lot of the other markets internationally, especially in Europe right now, there's pressure again to the downside. The bears are waking up. They're trying to roar. While we haven't got above this previous resistance, interesting to see what happens in and around this level, right? So keep that in mind. How's the Dow Jones looking in perspective? There it is. There's a previous high. Here's the all-time high, but any other market's not really liking that internationally. They're actually trading at resistance levels, so that could also give us some downside pressure that coincides with the resistance, that coincides with the divergence on the S&P 500. All right, so we're a very interesting key level here. Any questions so far on the overall equity markets before we jump into our individual stock analysis and talk about trade setups? DX, yeah, the dollar. How's the dollar doing? Ask somebody. Well, the dollar has gone up the last couple days, which is interesting because whenever it goes up, as the price of markets go up, that's a good thing. All right, the value of the market goes up. The dollar value also increases. This is actually an increase in wealth, in real wealth, in purchasing power as well. There you go. But on the same token, the yield or the lending rates have spiked about 2.6%. Anything above 2.66, while we're off that 2.8 and eventually up to the 3% back in December. The higher this rate goes, the more it's going to test our ability to hold on to debt. All right, to hold or service debt levels. Remember, the yield rate, the higher it goes, the more expensive the debt, the more return on an investment as well if you're looking for income. So there you have it. Any questions so far? Okay, so we're going to get kick-started with our Market Analysis Live here in terms of each individual stock. We're going to look through them. We're going to make some magic happen here. All right, so fasten your seatbelt. Let's go ahead and let's do this. Let's start with Apple.